If you look at where the economy has been in past cycles, when it's been around these levels, we've been pretty much either we've been in many cases moving towards a recession, and you can also say we were moving towards a soft landing. So it's kind of in never land right now. The last tick was down; it was a small tick down. But pay close attention to this. We think there will be more ticks down, because we do think that today's unemployment rate was a harbinger of more soft employment numbers to come.
Cathie pointed out the slight downtick in economic indicators, hinting at a potential increase in unemployment rates and softer employment numbers ahead. Such trends are crucial for understanding the broader economic environment, especially in sectors heavily influenced by technological advancement and investment trends. As we look at these indicators, it's important to reflect on historical patterns to better predict future movements. Historically, similar economic conditions have often preceded recessions. However, with the unique circumstances of today's global economy, influenced heavily by recent global events and shifts in technological adoption, the outcome might be different this time around.
We got a soft employment report. Non-farm payroll was 175,000. Expectation was up 240,000, so a big miss there. And if you look at the revisions, I think the downward revisions were 22,000. And we've had consistent downward revisions, which is consistent with, I would say, not a soft landing, a harder than expected landing. Another thing that goes into these statistics, and I haven't really talked about it before, it's pretty consistent though, is something called the birth-death ratio. And this has to do with new business formations and bankruptcies. When we're going into a recession, that number tends to be revised down. Normally, the net number is a positive, and this last month it was 110,000 jobs net from this net new business formation. Well, if that's wrong, and as we enter into recessions or harder landings, banks refuse to lend money, and they are refusing to lend money to small businesses, and small businesses are not happy about this. Probably means that 110,000 increase in employment because of net new business formation is an overestimate. So the employment numbers are probably weaker than what we're seeing now. And that's corroborated by the household employment measure, which was up only 25,000 last month. We saw average hourly earnings up 0.2%. 0.2% less than the 0.3%. It's down to, on a year-over-year basis, average hourly earnings growth is down to 3.9%. We got a productivity measure this past week, which on a year-over-year basis, non-farm productivity was up 2.9%. If you subtract that from the 3.9% in terms of average hourly earnings, or even the 4.8 in the employment cost index, we're below 2% inflation. And so on this metric, which is the real way you should be looking at, certainly wage inflation, we're below 2%. And, I think that that is going to continue to drop if we're right and the unemployment rate goes up. There was one other thing to note, and that was the unemployment rate itself went up to 3.9. We think in the next year it could go up to 5%. And these moves tend to happen rapidly. Here you can see non-farm payroll employment on a year-over-year basis is pretty much flat. I think it's 0.3%. That's with today's number. And you can see non-farm payroll has dropped below that 2% to 1.8%. And we think the deceleration will continue. If we go to the next chart, temporary help was down another 16,000. And you can see, except for the COVID shock, you have to go back to, I think it's 2014, to see temporary help employment this low. So businesses tend to not hire on a temporary help. If times are getting tougher, they'd prefer to cut back there than cut back on their full-time employment. On the next page, quits rate. The quits rate, it continues to fall. People quit jobs, and you saw this in the aftermath of COVID, if they think they can jump to another job and get a higher wage rate. You can see that's been coming down. We're now where we were before COVID. Actually, you have to go back to 2017, 18 to see a lower number here. And you can see that the employment cost index is coming down on a year-over-year basis alongside this quit rate. Here is another reason the restaurant sales are starting to capitulate. The personal savings rate is at a very low level. You can see before the 08-09 crisis, the saving rate was similarly low. What was happening back then was home prices were spiraling to the upside, and consumers were tapping into home equity to supplement their consumption. Consumers are not doing that now. The interest rates are too high, so they're not taking home equity loans like they were back then. So saving rates very low. If the unemployment rate now goes up, the tendency for this number, and you can see this, what happens before the shaded lines on each chart here, if the consumer feels, or consumers feel they're going to lose their jobs, they actually try and bolster their saving rate, which really hurts consumption. So maybe one reason those restaurant sales are starting to come down now. Here, just a reminder that we've been in a rolling recession. To see existing home sales drop from nearly 6.5 million units to we're now in the 4 to 4.5 range. That's been a huge hit. Of course, interest rates directly implicated there. On the new home sales, you can see after rising from 2010 to 2020, they also have been in somewhat of a recession territory. You know, there is a housing shortage out there, and yet interest rates have destroyed affordability. And so even here, we're continuing to see weakness.
Following up on Cathie Wood's insights, let's delve deeper into the recent employment data she highlighted. The latest non-farm payroll numbers came in at 175,000, significantly below the expected 240,000. This miss is crucial, as it not only reflects the immediate state of employment, but also suggests a trend of consistent downward revisions. Such revisions are indicative of an economic reality that's perhaps harsher than many forecasts suggest. Moreover, Cathie discussed the birth-death ratio, a metric that considers new business formations against bankruptcies, normally a positive figure. This last report showed a substantial adjustment, which could be a red flag signaling tightening conditions for new businesses, particularly small enterprises. This tightening is often a precursor to more significant economic downturns, as banks become more conservative in their lending, particularly affecting the backbone of the economy, small businesses. Adding to this, the unemployment rate ticked up to 3.9%, with projections suggesting it could rise to 5% in the coming year. Such rapid changes in unemployment are significant. They not only affect consumer confidence and spending, but can also lead to broader economic shifts, impacting everything from housing markets to investment strategies.